All right. So we are here on Raw and Relentless with Bo DePaoli. I brought my good friend John Azar on. Super excited to have you on, John. Thanks for coming on. So if you could tell the listeners a little bit about you and what you're up to.
Yeah, thanks, man. It's always great to join you, no matter what you're doing, brother. So I'm always excited when I'm talking to you, when I'm next to you. So it's when I'm sharing a donut with you. It's all good. So whenever I can get you to eat a donut, that is.
Yeah.
Yeah, lots going on, man. Lots going on. That's like a loaded question for me these days. What's going on? It's a whole lot going on. We're deploying from our fund. We're trying to allocate into some great opportunities for our investors. We're launching a couple of new business lines. We're still finding some equity for folks. So it's a loaded basket of goodies these days that we're working on. It's just a matter of you know juggling what's important, what's not, and kind of prioritizing. And we're a small agile team, as you know, and so just really finding the time to do it all.
That's key, right? Time is the biggest commodity everyone can have. Everyone thinks it's money, but it's actually time.
Time is definitely the biggest asset that is on Earth. That is that no one can buy. Well, you can buy, I
Right.
guess, time by hiring somebody else to do some things for you, but you can't get any more of it. It's always deploying, and you can't get any more of it.
Right. So, one thing that I love that you're doing is the fund, which most people that have a fund, they're not running the fund like you are. You are actually running a CoGP fund. So, could you kind of explain the difference between a CoGP fund and a regular fund that's out there that's investing in various deals, whether it's real estate, business, whatever?
Yeah. The CoGP fund essentially is as the name implies rather. It's a fund that really deploys the investments in deals that we become a partner on in some form of way or fashion, and in some percentage. It's not always the same, and not every deal is the same. We are very opportunistic by nature. We are conservative by nature in our underwriting, but we are also very agile in terms of what we're looking for and how we pivot. We pivoted earlier this year from looking at a lens of the multifamily spectrum into diversifying into a lot of other asset classes that are just making more sense to us these days, considering where the market is and where it's headed and what we're seeing out in the market. Truth be told, is the deals that we thought were going to matriculate in the market, 7, 8 months ago, 9 months ago, just not here. They just didn't hit the market where they're supposed to, because the dislocation in the market and the supposed recession never really took hold. The numbers in the economy are still pretty strong, so it's kind of like it's a really weird sort of conundrum, I guess, economical conundrum for those forecasters and economists that are handling this thing, because the all aspects of the economy says that it's chugging along really well, but there's this underlying layer of toxicity that is going to rise up to the surface at some point.
Hmm.
You know it is. You know it's coming. You just don't know how much of it is coming, and you don't know how soon it's going to be here.
Hmm.
But we all know it. We all can feel it. We are certainly starting to feel it in the commercial real estate, in terms of, like, the toxicity of some older deals that have happened in 2021 and 2022 or even 2020. Some of those deals are starting to really come to the surface now and bubbling up like ooze, where you can, a lot of the lenders and people that are looking at deals like we are on a day-to-day basis, they're starting to see. So those are the deals that we really are excited about. But they're not coming fast enough, and they have not shown their face as at least as quickly as we thought. So we pivoted. We started looking into more alpha strategies that are going to be great for our investors. The returns are going to be there. It's going to give them the right sort of the right ROI. It's going to give them some good cash on cash. So we've diversified. Where our fund is really very alpha driven fund. I'd say it's got a very it certainly has a multifamily leaning, but it's certainly not a multifamily fund. It's just an alpha CoGP fund where we partner with other sponsors and operators on their deals. We deploy out of the fund in the general partner capacity of the deal, and then we bring alongside of us some of our institutional partners and family offices to fill in the gap on the equity funding that is needed to get the deal done, meaning the LP or GV side of the equation.
Right.
That will change next year because next year we're launching an LPJV fund that's going to be over $100 million. And we're really excited about that. That's going to start taking place of those institutional and family office partners that are coming alongside of us. Not that we don't want to do business with them. Obviously, there's going to be still deals that we're not going to be able to deploy into per se, but that we'll lean on our partners for that. But it will certainly expand our strategy a lot more. I think next year will give us a lot more firepower and agility to pull the trigger on the right deals that we think are going to be good for our investors.
Yeah, and so people understand the difference between GP and LP. LPs are basically just passive investors. They're not handling the day-to-day of the business or the property, but the GPs are doing all the heavy lifting. They're the ones putting the deal together, operating the deal, all of that stuff. So you're really partnering with those guys that are, feet on the ground operators and that have a good track record, right?
That's right. That's right. Yeah, we're not interested in going in with someone who's just coming out of the gate, or they're just trying their first or second deal or something like that. That's not going to, unfortunately, it's not going to cut the due diligence for us. We do a good amount of due diligence on the sponsor. Really, at the end of the day, Bo, you've heard me say this 1,000 times. It's all about the relationships. For us, the deal starts with the people, not the deal itself. The deal actually obviously have to make sense. We do look at the deal from a numbers perspective, and we analyze it and underwrite it, and the numbers. If the numbers make sense to us, then we'll switch our attention to the more important part, which is the people. Who's behind this deal, who's going to be running, what's their experience, what's their background, how well are they working with us? That's really an important aspect because that's something people sometimes forget about, and I can tell you from experience, it's very, very important aspect of a deal, how well people are working with you on that deal. Because no matter how good the deal is, if you have someone that is just going to be oil and water as far as working together with you, it's going to make that deal go sideways really quick. You can have a great deal and it'll go to crap. It'll go to shit. I don't know if I could say shit on your podcast, but
it's raw, buddy. Just let it fling.
But it'll go to shit in a heartbeat if you have a bad operator or a bad partner. You can have a great partner and a really good operator and someone that you get along great and have a good relationship with, and sometimes be in a bad deal. Not necessarily that you'll start out in a bad deal, but you can get to be in a bad situation on a deal. But if you have someone good, you can make your way through it. You can find your way through it. You can find solutions.
Yep.
You can find a way you can find a solution. But if you're in it with a bad partner, man, it's just not good. So to us, people are really number one. It's people first, deal second.
Yeah, it's like a marriage, right? I mean, you got to have somebody that you can really just grind through it.
Absolutely, and that really sort of proliferated pretty much everything we do at Peak 15. I mean, every initiative we have, every business line that we try to launch, it's all people heavy. It's all relationship heavy. It's because we're very, very relationship driven. It's all about the relationship we build. It's all about what we can, how we can bring, what value we can bring to those relationships, and we give them, and hopefully what value we can synergize together on. That's really what makes a great partner. That's what makes a great, even a great investor for us. And I would think people would want it the other way around. I mean, you want to work and invest and be in a company of people that you like and trust and hopefully like to break bread with.
Yeah.
That's how you kind of judge how well you kind of like people. Life's too short, man. Life's too short to work with somebody that you just don't like or just put up with. There are way too many assholes and not enough good people out there.
Yes,
so
this is true.
We gravitate towards the good people.
Yeah. So what's typical return structure that you want to see for Peak 15 and through the Alpha Fund?
What trajectory is that what you said?
Return, like what kind of return metrics are
Oh,
you trying to?
return metrics are going to be higher for our GP fund than normal sort of syndications and LP fund, just because it is investing everything as a general partner, or at least it's getting some general partner promotes or returns. Promotes, for those of you who are not familiar with that word, it's essentially the sort of the profit that goes back to the general partners out of a deal, out of a syndication, or out of a fund, or out of whatever. There's a portion that's carved out to investors, and there's a portion that's carved out to the general partners. And that portion that goes to the general partners is the portion that we try to capture as much as possible from our fund. So as a result of capturing that, our fund generates on the average anywhere between 1.5 to 2x times the normal returns. Meaning that if an average return on a syndication or fund, a normal LP fund is about, let's call it 16 to 19%, our fund is expected to average anywhere between 25 to 35%.
That's
So
great.
the returns are commiserate to what you're trying to do.
Those are great returns.
Yeah, yeah, and that's why it's harder for us to find the right deals, because we are very picky and we really want those returns for our investors and safeguard them. But that's the other reason we pivoted into also trying to in locating other asset classes and other sectors in the commercial real estate that just are making a lot more sense these days. Different kind of deals altogether. In the next 90 or so days, we're looking at 3 or 4 completely different kind of deals. But the common denominator between them is that they're in commercial real estate and they have great returns to our investors, great cash on cash, and they have a good upside on the other side of the coin when.
How did you even like get started in this whole industry? Where did it all begin?
Oh man, where did it all begin? Well, I guess when I first got started, my first venture in real estate, my first company I launched in real estate was back when I was in Boston, back in '04, '05. I was in trading and equities and derivatives, and with a couple of partners at a couple of big shops like Morgan and Royal Bank of Canada Capital Markets Group. And then we formed a company called Boston Venture Partners that is essentially acted as a structured finance shop for large-scale mixed-use developers and financiers across up and down the East Coast, the Eastern Seaboard, and and we did really well. I mean, that was a great time between '04, '05, and '09. I would say '08, '09. And then something happened, as you remember, in '08, '09 that completely dislocated the market. But we had a good run. We had a good run for 3, 4 years while it lasted. And we did projects that are, most of them were development projects. Most of them were, some of them were a lot of waterfront development projects that were contaminated, had brownfield issues and contamination tax credits from the government, and anything from luxury condo developments in Boston Back Bay to waterfront developments in Philadelphia and Boston and Charlestown Navy Yard and in New York in the Bowery District. We had projects all over the place, and like I said, unfortunately by '09, our business dried up like a prune, and pretty much everybody went away. I mean, everybody went away. Our investors, our developers, like everybody wanted to go into a cocoon, and unfortunately, we had to kind of shut our doors on that business in 2010.
Wow.
But that's okay. It's a lot of lessons learned, and thankful for all the experiences that we had. And you just kind of lick your wounds and put a couple of band-aids and on your boo-boos and get up and do it again. So that's just what happened.
And then, so where did you go from there?
From there, I went back into the workforce, and I worked for different. During the whole time, I've been involved with banks and institutional finance shops, like John Hancock and more, and went to work actually in commercial banking for a while. Had a stint in venture capital, and then finally landed back in real estate like I wanted to. With my brother. My brother was just formulating a syndication platform in the Carolinas that was acquiring multifamily homes and multifamily real estate. Started doing that in right around the time when the crap hit the fan for us at Boston Venture Partners around '09 or so, '10, and then by 2013, 2014, he's built up enough momentum to warrant sort of a serious expansion and serious kind of rebranding, and that's where I came in and kind of helped blow up the platform and became a lot more institutionally driven and got a lot more investors. Continued to do a lot more deals, and kind of managed that for the better part of 6 years, 7 years. We did that. We transacted pretty actively between 2013 and 2020, and then in 2020 we decided to sunset the portfolio that we had. Just my brother wanted to kind of take some chips off the table. A good time to take chips off the table and pursue some other interests and some other ventures. And I did the same. I launched Peak 15 Capital in 2020,
And
late
so,
2020.
how big did you guys grow that portfolio over the course of that 6 or 7 years?
We transacted probably around 5,500 doors, 5,700 doors. The biggest that we've ever gotten with assets in house was probably around 4,500 doors or so. Because we always had sales and disposition, acquisition, that kind of stuff. So you don't always maintain the same number all the time, but yeah, right around 4,800 doors was the sort of our top that we had at the time, and they were mostly in the Southeast, in the Carolinas, Georgia, Tennessee. Had some condos in Florida and a couple of commercial real estate assets in Texas.
Very good. So, what do you think was the hardest part of scaling a business like that over the course of 5, 6, 7 years, growing from that smaller size up to, let's call it, 5,000 doors, right? In that matter of time,
Yeah.
which is a lot. That's a lot of doors.
Yeah, it's a lot. It's definitely a lot of doors. We were vertically integrated. My brother had a property management company that he launched earlier on after our first inflection point of having about 1,500 doors or so. Launched a property management company in house, so we had that going as well, and that was really the biggest drain of really human resources. I mean, it's running a property management company is really where it's very people intensive, very people heavy. Not something I understand the value of it. I understand the sort of what it brings to the table. I'd say I'm hot and cold. I'm having your own vertically integrated property management company. Sometimes it's great, sometimes it's not so great. People tell you they can control cost. You can somewhat control cost if you have a third party property manager company as well. It's not like you can't control cost there. I mean, the costs are the cost. Lumber's lumber. So whether you buy it for yourself or whether a third party property management company is buying it for you, yeah, you get to have a little bit of savings at the same time. But to be honest with you, running a property management company as a third party sometimes give you the ability and agility to change direction a lot quicker than if you're running your own property management company, because sometimes you get stuck in your own ways and you just don't see the forest from the trees. So it's there's pros and cons to it, but yeah, man, I mean, it's scaling that to that much. It definitely requires. I think the biggest thing was just kind of getting used to sort of the frantic pace of looking at assets acquisitions, and you got to be entrenched in the numbers. You got to always kind of be looking into the next raise and the next raise and the raise after that. When you're syndicating about four to 8 deals a year. Let's call it 5 or 6 deals a year even. That's a lot of deals. I mean, that means you're raising every other month. You're raising.
Yeah.
You're going out to the market and raising and going back to either your investors or trying to get new investors or So you're constantly in that sort of raise mode
Mm-hmm.
in terms of the acquisitions are concerned. You're constantly in the mode of looking at assets and visiting and managing the old assets that you have. You're constantly in the mode. I mean, I think that frantic pace is really sort of running that type of platform is certainly could be onerous
Mm-hmm.
for a while. If you surround yourself with the right team, it obviously that heavy lift will get reduced. But yeah, it's not for the light of heart. That's for sure. I mean, it's a lot. It's a
What
lot to do.
What do you think? Do you have any idea what the most you've raised in a year is for some of your deals?
God, and then probably at one point maybe like around $40 million, $45 million for some of the deals that we had. So I mean, it ranges. We used to raise anywhere between 2 million to, let's call it, 15 or 20 million per deal.
Mm-hmm.
So it just
Mm-hmm.
depends on what the deal is and how much of those smaller deals that we got as opposed to the bigger deals that we got.
Mm-hmm. Mm-hmm.
So, but yeah, I mean that's really one of the difference. That's really what got me to actually launch Peak 15 Capital and what I wanted to do differently as a private equity platform as opposed to a syndication platform. But I think coming from the syndication platform, coming from being the sponsor of a syndication platform in multifamily, really taught me a lot of great lessons. And running a private equity shop now as we do at Peak 15, we really wanted to approach everything from the lens of a sponsor and what it looks like, and it makes us a lot more relatable, I think, to a lot of sponsors. It makes us a lot more relatable to developers and operators and sponsors because I mean we know their business. We've been there. We've done that.
Mm-hmm.
We understand their pain. We understand what they kind of what motivates them on a day-to-day basis. We understand what a good deal looks like from a term sheet perspective. What it doesn't look like. So that helped a lot, but at the same time, running a private equity platform and running a fund in particular is a lot different than running a sort of a syndication platform where you're just syndicating every couple months, 2 or 3 months, you're syndicating, going back out to raising, going back out to raising, syndicating, going back out to raising, syndicating. And even the investors sometimes they get tired. There's an investor fatigue that happens when you do one-off syndications one after the other.
Yep.
That's what we tried to avoid with launching the fund at Peak 15 is we wanted to kind of reduce that investor fatigue, but also give them exposure to multiple deals,
Mm-hmm.
while at the same time getting them to capture a bigger piece of pie than they would normally capture from a normal syndication.
Yeah. And so now with Peak, I think I think the biggest thing, right, is if you look, especially for yourself, because I had said this on my first or second podcast. I had said, when the housing market crashed, people couldn't afford homes, right? Because the market was just crazy. I mean,
Sure.
everything was just shutting down, basically, like you said. I had said, watch, the multifamily sector is going to blow up because people can't afford homes. So they need a place to live. So they're going to go to apartments, right? And so you and your brother, really got in an opportune time. And so, like you said, you're transacting basically every other month, right? So for close to 10
Mhm.
years, you're doing, say, 5 to 6 deals a year, right? And now fast forward 10
Right.
years, you start Peak, and now multifamily market has just, like, because rates were so low, everything was just so hyper inflated in terms of price to be able to get the returns that you need through your fund. You're probably not transacting that amount every year now, right? Through Peak.
No, no, it's not. It's not that at all. No, we're not. And but we will be.
Mm-hmm.
I mean, we're only growing. Obviously, next year when we launch our big fund, our LPJV fund, the amount of transactions will obviously increase,
Mm-hmm.
and therefore we're going to need to hire more people to handle
Mm-hmm.
those transactions. But you're not in a people intensive business. I mean, we can grow a multi-billion-dollar portfolio with not many people. I mean,
Mm-hmm.
you don't need hundreds of people running that kind of a shop. We're always trying to be lean. We're always trying to kind of stay manageable and agile and close. I don't ever want to run a company that is I don't know who's working for me.
Sure.
So I mean
Right.
that's way too big. So I'd like to know all the people, know them well, the people that work for us and work with us, and I think we can accomplish that with a lot less headcount than people think that we can.
Hmm.
Again, we can run a multi-billion-dollar company with less than two dozen people.
That's impressive. That's impressive.
Yeah, I mean, you don't need again, Bo, you don't need manpower to run money. I mean, you do to some extent, but you don't need that much manpower. You're
Hmm.
really your manpower becomes in the analysis of the deals.
Hmm.
You need a couple of acquisition guys. You need some analysts. You need a couple of operations guys. You need some internal guys, internal folks to run internal operations, and you need some investor relations guys. You need a lot more of those guys probably. You need a few of those, and then you're off and running, and you're off to the races. You need asset management. Obviously, I forgot about asset management. You need asset managers also
Hmm.
in house, but you can accomplish all of that, with the kind of headcount I just mentioned, and still run a multi-billion-dollar portfolio.
Very cool. What do you think is um, what do you think is some of the biggest headaches or challenges that you deal with on a day-to-day business, especially being I mean, you're basically a startup in a way. I mean, even though you've been around for 4 years, it's still you think
Sure. Oh yeah,
you
of
still
course.
think that's
Yeah.
still very infant in most businesses, right? So, what do you think is some of your biggest challenges and headaches that you deal on a day-to-day basis with Peak? What keeps John Azar up at
I,
night?
I think finding the right deals for our investors. That's really like making sure that we're pulling the trigger fast enough on the right deals that are going to get the right returns for our investors, and maintaining those sort of good returns, or maintaining the sort of the quality of the deal during our whole time, and obviously seeing a good exit at the end. So really finding those deals have been, probably I would say the biggest stress these days, because the deals are just that that were going to be in the market are just not there, and you have to dig a lot deeper. You gotta find that diamonds in the rough these days, as opposed to, it's not gonna smack you in the face,
Right.
because contrary to what people think, I mean, there's a lot of disconnected deals out there. There's a lot of deals that are bleeding and coming back into the market, but that doesn't necessarily mean that they're still a good deal.
Hmm.
Even deals that are coming back into the market through lenders, and we're starting to see a lot more of those coming through from lenders that are being marketed from lenders, who are calling me, and saying, "Hey, John, we have these deals. If you want to take them off our hand, if you want to buy them at the debt cost on these things." Even those deals are sometimes not, a lot of times are not good, are just
Right.
they're still not good. If I buy them at cost of the debt, they're still not good, because the cost of the debt was probably, at the time that they bought them, the entire cost of the deal was inflated. So
Hmm.
therefore the debt was probably inflated at that
Hmm.
point. So if you
Hmm.
buy a deal in 2021, 2022 under those crazy underwriting that used to happen back then,
Hmm.
and the lender was giving 70 to 80% leverage LTV on those deals, 75% LTV on a deal from 2021 that was, way overpriced to begin with. you
Hmm.
know if it comes back to market now, that 75% leverage on that deal, 70 or whatever it is, it's not enough. It's not
Right.
enough to make it a good deal.
Right.
Because that's because it probably, now that deal is probably worth 15% less than what it was back in 2021 when it was sold at the height.
Right. It's definitely a different market, right? I feel like it's changing every week. It's something's different with it.
It is. It is. It is changing every week, but it's still, listen, man. It's a cycle like any other cycle.
Yeah.
I mean, I'm not gonna sit here and entertain sort of the doomsday scenario, which is a lot of people sometimes like to. They all
Hmm.
like to gravitate towards drama. They all like to gravitate towards negativity. I'm not that. I'm not that person. Look, if you're in the market, you're looking at deals, you'll find the right deals that are going to be great for you, great for investors, great for returns. That's bottom line. Like, just get the job done. Like, that's
Yeah.
all there is to it. We can sit here and bitch all day long about how bad the market is, how, what a rough market it is, what a turn of the event it is. Woes is me, I can't find deal. Well, whatever. Like, just shut the hell up and just do your job, and go out there and look at deals and analyze them, and you'll find the right deals. Like
Hmm.
it's not rocket science. Yeah, it's taken a lot longer, obviously these days, to kind of dig through the rubble and find the right deal, but they're out there, and they're out there. You just need to find them. That's all there is to it.
Is there?
So I'm.
Yeah, sorry. Go ahead.
Sorry, go ahead. No. That's it.
Is there? Are you kind of agnostic as to where you're looking for deals, or do you try and focus on a certain area of the U.S. or the world?
I mean, look, we look for areas that are economically viable,
Hmm.
and both from a demographic standpoint, from a sort of political economic standpoint, for whatever. Like all these, we take everything. We do a holistic approach on our acquisitions. We go macro and then we go micro, or sometimes the other way around. Sometimes we start micro and then we go macro. So
Hmm.
meaning when
Hmm.
when I say macro and go micro, meaning that we sometimes look at the property level and then focus and zoom out and look and see what's going on. Or sometimes we look at the overarching market from a macro level and then zoom in to the micro level, to the property level, or to the asset level, to whatever that asset happened to be, whether it's a
Hmm.
multifamily asset, or a car wash portfolio, or a land entitlement deal, or whatever it might be. So you gotta do again, the way that we look at areas, that as long as the economic viability of the area is there, and as long as the growth is there, and the demographic movement is right, the crime rate, the average household income. I mean, all of that is taken into concert to kind of formulate that picture, that mosaic that we like to kind of use when we do an analysis on deals. And then we kind of obviously zoom in on the property itself, the financials, the rent rolls, delinquencies, and then you also kind of bring in the prevailing laws of that area. What are the eviction laws? What are, if we're dealing with multifamily, what are the eviction laws are like, and tenancy rights and all that kind of stuff. So you got to take all of that into consideration when you're looking at an asset. You can't just look at an asset singularly and say, well, wow, this asset is kicking out like some amazing returns. Yeah, it could be kicking out some amazing returns now, but where is it? Where is it going to be 3 years from now, 4 years from now?
Hmm.
Who's going to buy that
Hmm.
asset in 5 years? 5 years from now?
Hmm.
Yeah, it could look great on paper, that one asset in that one small dinky, place in the middle of nowhere. But who's going to buy it 4 years from now from you? Who's going to be that buyer pool? And that's really important for us. It's important for us to understand the exit before we even understand the entry.
Hmm. Is there any markets that you are like you're hyper focused on, or you markets that you really like right now?
I mean, we're still big fans of the Southeast and Sun Belt. So anything that's in the Southeast, and that's kind of like Virginia and below and south, and then anything west of Virginia and all the way out to, I'd say, Colorado, would probably be something we're interested in. We are, we're not investing necessarily on the north, on the west coast per se, meaning California. We might look at Oregon, we might look at Washington. It just depends on where they are. But
Hmm.
overall, probably not California. Probably not a lot of places in the Northeast. At least the major metro areas like Boston or something like that is probably not going to work for us. But we'll look in Chicago. We'll look in Chicago area, Indiana, up and down sort of the Ohio River Valley region. So
Hmm.
that's those areas are all appealing to us. Again, Bo, it's about the deal,
Yeah.
and then we'll look at obviously the area matters, but it's about the deal and what the deal is, and what can we do about the numbers. Because look, you can solve for, if you have a deal that have micro issues, meaning that if you have a deal that have some disconnections that you can solve, meaning operations, construction, rehab, whatever. I mean, you can solve for things like that. You can solve for management, better management. You can solve for better looking asset. You can solve for better control of construction, and better control of operation. What you cannot solve for is what the area is going to do, because that's
Hmm.
not, unless you some gigantic influencer and can predict what an area is going to do and what's not going to do. That's really something you can't do anything about. You can't do anything about the area. If the area is going if the area is going to shit, you can't do anything about that. I mean, that's just, if it's decreasing population, you really can't do anything about that. What are you going to do? Try to increase the population in the area? So
Yeah, right.
there's some things that you can do something about, and there's some things you can't do something about, and the things that you cannot do anything about are the things that you try to at least match as closely as you can to your rigor, to your
Hmm.
underwriting rigor and underwriting standards, because they got to match it. Because if they don't match it, there's no, you can't, you've heard me both say that to everybody, including you, and including to all of the team that we have here. Hope is not a strategy. Hope is not a method. So you
Yep.
can't you can't just buy something and hope that things are gonna. What are you gonna do? Buy something where it's in a crap area, in a crap neighborhood, and hope that it's gonna improve in the next 3 or 4 years?
Right.
You
Right.
can't do that. Now, if you know there's some significant improvements and significant changes coming to the area, that's different. That's you've done your research. You know that there's a new construction coming where there's going to be some, who knows? Boeing is putting up a plant, or
Hmm.
Amazon is opening up something, or
Hmm.
there's going to be some huge city planning and rezoning a project that's going to really put a lot of eyes on that area and a lot of influence economically on that area. Those are great. That's great. That's what you need to know on an area. But if,
Hmm.
if in the absence of that, and you have to make a decision with the information you have, not
Right.
the information you wish you have, just the information you have.
Right. 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 No, that totally makes sense. So, what else are you working on with Peak? Anything that you can share?
Yeah, man, we're launching a new initiative that I'm really excited about. That are really somewhat of a departure from our normal sort of day-to-day business, but it's something that's very close and dear to my heart, and it's something that I think would get a lot of people excited. We're launching a new. Again, I'm hesitant to say mastermind, because the word mastermind have been sort of used and abused in way too many ways,
Yeah.
in the financial industry, really in the professional world. You hear mastermind, you're like, I don't know about you, but for me, like, I roll my eyes sometimes when I hear mastermind, because
Mm.
it just a lot of, and I've been parts of a lot of masterminds. I wanted to launch something that is really more of a high level executive network. Yes, it is a mastermind, because I've been racking my brain to try to find a better word to use than mastermind. But
Roundtable.
at the end of the day, roundtable, yeah, that could be. But at the end of the day, people know it as a mastermind. So
Yeah.
so we're launching a new mastermind, but to me, it's a high level executive network. It's going to be called Peak Titans, a completely new brand, completely new company. It's going to really, the idea behind it is to bring the synergies of high level, high performing executives in the financial services industries and various aspects of financial services. This is not just for commercial real estate necessarily. Commercial real estate is certainly going to be one place, but this is for folks in venture capital, commercial real estate, private equity, hedge funds, financial services, law. All of those sort of make up the anatomy of what someone would want to be part of, as
Yep.
far as peak titans are concerned.
Yep.
And we're creating this close knit community of these executives that would get together. We're gonna get together on a weekly basis, exchange mindset, mentality, deals, obviously. I mean, look, deals and deal exchange and capitals and capital ideas, capital raise ideas. That's standard. I mean, that's not going to be something that, at least to me, it doesn't really. That's not the exciting part. That's not really where
Right.
the magic juice is. The magic juice for me in Peak Titans is the way that we're going to really concentrate more on mindset, motivation, accountability, and really building that tribe to be to be powerful within themselves.
Hmm.
We're also going to be doing quarterly adventure meetups, or retreats. We're gonna call them retreats. We're doing quarterly, so you get a weekly call paired with a quarterly retreat for all the members in different parts of the country. And these quarterly retreats are really what's going to kind of set us apart also from other masterminds. These quarterly retreats are going to be at higher end locations. They're going to be at locations where it allows for some aspect of adventure,
Hmm.
to push people to kind of do something outside of their comfort zone a little bit, and also give obviously the sort of nomenclature of networking and getting together. And we're going to have our retreats are going to not going to be long. They're not going to be hosted in some conference center and have breakout rooms and all that kind of stuff. That's not what our retreats are going to be about. Our retreats are going to have a networking component. They're going to have a sort of an informational component. We're going to have things like a panel or fireside chat or something like that. But that's only going to comprise about half to three quarters of the day, and then the rest of the time and into the next day is really where there's a component of an adventure that's
Hmm.
infused in those retreats as well. And then the different location depends on the location. Like, it's going to be germane to different locations. So
Hmm.
if we're hosting something in, which we're going to be hosting something in Utah, for instance. We're probably going to have integrate some kind of a half day. We're going to always give out two different activities, either like a hunting or bird shooting or something like
Oh,
that,
wow.
paired with something else. Like maybe that's not your thing. Maybe your thing is more of hiking or golf or something like that. So we'll pair that with it as well. Or maybe it's happening in an area where we can do some mountaineering or some mountain hiking or something like that. And then we'll do that as sort of the adventure activities. Maybe it's jet skiing, maybe it's snow skiing, whatever it might be. There's going to be different locales, four retreats per year, paired with weekly calls and sort of the monthly power calls, what we're going to call them, where we're going to bring in some really impactful speakers. And then there's going to be obviously paired with the infrastructure of a network where you can kind of always exchange ideas, always sort of exchange deals, and try to make sure that you're performing at the highest level possible and being motivated, also, and have the right mindset and mentality to kind of approach that. Whether you're the CEO of a big company, or a venture capital company, or private equity company, or hedge fund, or whether you're sort of a managing director or an executive at those companies, or director of acquisitions, whatever it might be. We want you to kind of shift your sort of mindset, mentality, and focus on not only just getting the business aspect of it done, but really sort of getting your mind in the right framework as well.
I love it. I honestly, one of the, because I've been part of several masterminds myself or roundtables, and probably the one of the best ones, retreats as you call it, that I ever went to was in Austin. It was literally that. It was a learning session. It was lunch, and then we went off to an F1 course, and we did high speed go kart racing.
Nice,
It was so
nice.
fun, but it was just like, it's nice because, like you said, a lot of times it's at a conference center and it's just 3 days of just talking and talking and talking. And you build, like you said at the beginning of the podcast, you really build those relationships when you kind of get out, right? And you do those things together. So that's
You
great that
do.
you're doing
You
that.
do. No, absolutely. Yeah, no, you do. And look, anybody can create something that's going to have your normal 2 to 3 day conferences, and you bring
Hmm.
speakers, and you have breakout sessions, and you have sessions about what's going on with the economy, and let's lament about this, let's lament about that.
Hmm.
I'm not interested in complaints. I'm not interested in complaining. I am, I have like I have like an allergy to complaints. I don't like complaining. Not for me, and I don't, and it keeps me out when I sort of, I don't like to get into that mentality. I have to keep motivated on a regular basis. I have to kind of keep going forward, and to find a way to get things done. And that's just how it is. And so so that's really kind of the guiding principle of Peak Titans, is that we want every member of the community, every member of Peak Titans, to kind of feel like they look forward to those calls. They don't, to our retreats. They look forward to our calls. They look forward to our retreats. They look forward to our meetings, because it's something that's going to set their week up straight, and it's
Hmm.
also going to give them an opportunity to be performing at that level that they need to perform, and be in a room with like-minded people that are
Sure.
in that level as well.
Sure.
And the reason I wanted it to be multi sort of sectors, meaning not just for commercial real estate and not just for venture capital and not just for private equity, is because you never know where your sort of the next kind of relationship opportunities are. Again,
100%.
we started out this podcast with me talking about how important relationships are to me, and they are, and that is, again, is still the guiding principle behind Peak Titans, is because we want to encourage people to build those relationships and have those relationships, but we also want them to be genuine, and long lasting, and something that's impactful and synergistic to everybody involved. And really, that's really the method and the message behind Peak Titans.
That's awesome. So how long are the retreats going to be? Like how many days?
2 days. Two
Okay.
days.
That's
Yeah,
beautiful. That's
the
perfect.
retreats are, yeah, no, the retreats are 2 days. We don't want. I've always kind of been of that mindset. Again, I don't need to waste like 3 or 4 of my days on some conference where I'm just going to go there and where half of it is just going to be useless. So I want the 2 days to be, one day of impactful information, or maybe half a day or 3/4 of a day, and then the rest of the time is an adventure tied to it, depending on location. And then we have a power dinner, and then we depart, and that's really how it is.
That's great. I love it. So when do you think you're going to officially launch that?
We're looking into, hopefully, in August. Very
Nice.
soon. We've been working on it for a while. Yeah, we've been working on it for a while. I've really just kind of started talking about it. I just talked about it yesterday, actually, on a podcast, and I'm talking about it today now with you. So we're excited. We're hope that it could be probably we might start before, but officially launching the mastermind in August.
That's awesome. Keep me posted, because that'd be something I would be interested in. That's awesome. Especially if you're going to
Oh,
Utah.
yeah, Bo, dude, we talk all the time, so I know you're gonna know about it.
Yeah,
What are you
that's
sweating me
right.
for an email for? What do you think? I'm gonna wait to send you an email announcement about stuff?
Yeah, no. Yeah, no. Well, man, I don't want to keep you. I know you are a busy man, but I really appreciate you coming on, and always supporting me. And you know what? I just got to tell one quick story of how we even met, which is crazy, because when I decided to
Yeah,
launch D3 Capital, right, which was right about the same time as you started Peak, 2020, 2021. I just started to become a sponge on anything real estate, commercial real estate related. And so that's when the Clubhouse app started to take off, because everyone was stuck inside for COVID.
that's right. That's
And
right.
so
That's right.
Clubhouse
Is
got
that
really
is that app still
popular.
around? I haven't even been on that app in so long.
I think it is, but I don't know if it still has the traction that it did have a few years ago. And so I was on a like a real estate room, or whatever you want to call it, and you were in there, and you were one of the guest speakers.
Yeah.
And so I knew I needed to find a mentor, to kind of take me under their wing, and teach me things and whatnot. But what I loved about you is, this is how sincere you are, John. Is most guys that do any kind of coaching or mentoring program, right? They sell the shit out of it. They promote the shit out of it. And I shot you a message. I slid into your DMs, and I was like, "Hey man, can I just pick your brain for a little bit?" And we started chatting. And I said, "Hey, do you do any kind of coaching?" And you're like, "I do, but I don't really promote it." That right there, I was like, "That's the guy for me," because like, just shows how genuine of a person you are. So we go way back.
I appreciate that. No, it was awesome. No, we
Yeah.
do, and no, dude, it's a pleasure, man. It's been a pleasure having you in my life, and I'm grateful to have you in my life. So,
Yeah,
and
you
it's
too,
and it's
man.
I try to approach everything with the same mentality, man.
Yeah.
I don't take relationship lightly, and I don't take good relationship lightly. But I also life's too short not to be authentic. I don't get it right all the time. I try to be as authentic as possible, as much as possible. But I'm sure I don't get it all the time, because look, I'm human, and hey, we screw up.
Yeah.
That's just what it is. We're faulty. We're faulty
Yeah.
by nature. That's
Yeah.
just
Yeah, for
how we're
sure.
built.
Now when we go out, people are like, "Are you guys related?" because we got the beards, you know, and the
I
very
know, I
similar
know.
look.
We do. We do. Yeah, we got that. We got that last year. Remember when we went
Yeah,
to that
all
to
the
that
time.
conference in Newport?
Yeah,
We were like,
yeah.
you guys are cousins, brothers.
Yeah, yeah. All right, man. So where can everybody find
What
you? Where can they reach out if they want to get a hold of John Azar and learn more about what you're doing?
they can go to our website, peak15cap.com. They can email me. My email is azar, ZAR at peak15cap.com. Or they can, I want to say they can find me on social media. LinkedIn actually is probably the biggest one. I'm not really much on the other channels of social media. I have a presence on Instagram and Facebook, but I don't even have them on my phone. So I don't, it's not probably not the best place to get a hold of me.
Yeah.
Probably email and LinkedIn. I am on LinkedIn. So LinkedIn would probably be a good place.
Awesome. Thanks, man. I appreciate you coming on, and I look forward to seeing what you got coming up in the future.
I appreciate it, brother. Thanks for having me on.
All right, buddy.